You look at negative 2% over a 5-year period compounding, and you're significantly behind. That sets people back decades.
Look at that inflation data. If it is below 3%, you're in negative territory each year.
Inflation's been running at 3%, so you're losing money, you're going backwards. So if you net out all your costs, you're going to be well behind. This is purely looking at the numbers of these assets, what's underperformed during the tough times. If you don't time the market, you could cost yourself hundreds of thousands of dollars. And also, more importantly, the opportunity cost of not being in better assets during that period. Your downside risk is what I talk about a lot. Most sophisticated investors, first thing is, how do I protect my wealth?
Did any of the data surprise you when you went into it?
It only emphasised my point more dramatically that it doesn't sit well as an asset in anyone's portfolio based on these numbers.
You're listening to the Follio Property Podcast. I'm Reece Bedell, and I'm here each week with my co-host, Lachlan Delahunty. Lachlan, today I want to unpack 50 randomly selected properties, I should say, across Brisbane, Perth and Adelaide. So looking at different cycles in terms of where the property market's at. But the big thing we want to talk through is asset type. So I want to look at established houses versus terrace townhouses, versus units, which you will explain again what a unit is versus apartment, house and land packages, and apartments, which are larger complexes, generally off the plan.
So unpack the data, Reece. It's not an opinion piece. This is purely looking at the numbers of these assets, which asset type has outperformed the market in the good times, but also what's underperformed during the tough times. And what's important about this is we can take what's happened over the last 7 years and apply that when you're looking to invest over the next 7 years of what assets to look for and ones to avoid.
Okay, before we get into the data and we go through these, I'm not going to go through every 50 assets, but we're going to do a bit of an average in terms of each area, each city, I should say, and area. Did any of the data surprise you when you went into it? Or has literally, once you delve through these 50 asset types in different locations, different years when they were purchased, were they all kind of spinning out what you thought it would come at?
No, it's exactly. It only emphasised my point more dramatically that during good times, the quality assets outperform the markets. But more importantly, and this is what I talk about all the time, investing, whether it's in property or other asset class, it's all about your downside risk and reducing your downside risk. So investing is about defensive as well as being offensive. And it highlighted that during poor times, when you look at Melbourne as an example, the questionable assets, apartments, and house and land significantly underperformed. So not only did you get a more of an uplift in established homes and units in good times in the markets like Perth and Brisbane, those type of assets outperformed the market, but significantly outperformed house and land packages and apartments during the tougher times, which we've seen Melbourne go through over the last 6 or 7 years. You really see how poorly those questionable assets perform. So it really highlighted that point.
If you're serious about property, you need better inputs. PropStack is where our chief economist and research team puts everything together. Our leading investment reports, our suburb level data, and a weekly market update on what's actually moving. It's the same research our advisors work from, and you can get access now. Scan the QR code and click the link in the description. Let's go to the numbers. Let's talk through, before we jump into the exact numbers on each, say, city and an asset type, just tell the viewers or the listeners, we'll bring up some graphs for those that are listening if you want to visually see, but I'm sure we can explain this pretty well throughout the podcast. From a long-term sort of compounding growth rate, what in your eyes is a acceptable number that you should be looking at for a good investment?
So when we talk about long-term compounding growth rates, we're tracking that back 20, 30, sometimes 40 years, but it can lose some level of relativity if you're looking in the most recent cycle. So all the assets that I've gone and sourced have been purchased and sold within the last 10 years, and they've all been sold in the last 6 months. So it's really up-to-date, relevant data. And obviously that's going to be impacted because you could argue that Brisbane and Perth are at a top of a cycle and Melbourne's at the bottom, and that's why I've used 3 completely different markets, albeit Perth and Brisbane quite similar, Melbourne countercyclical to that. So it gives us a really good, I suppose, overview of 3 different markets.
Okay, let's do a high-level overview of all the markets and then do a bit of a deep dive into each capital city. Looking at established houses, Melbourne long-term compounding growth rate was at 7%.
Yep.
Perth was at 12%, and Brisbane was at 14.3%. Any surprises in that?
If anything, I was surprised that Perth and Brisbane had underperformed in comparison. If you look at, and these are random assets, the sample size was 50.
Yep.
So if you look at the actual Perth, Brisbane and Melbourne long-term compounding growth rates as a city, it's going to be very different to that. So this is based on this sample size. But, look at some of the assets we've purchased for clients recent, and me personally, they've been tracking closer to 20-25% compounding growth over the last 5 years. So that is very consistent with what I expected. Melbourne probably surprises people because it's been underperforming. Melbourne certainly hasn't been producing as a city 7% compounding growth, but these specific assets shows you the value and the protection of established homes, even in tough markets, still perform. So it sort of really highlights that still your your go-to asset, regardless of tax and external environments or lending environments, houses over the long term, and this you'd argue is over the short term, the last 10 years I'd say that short term, have still outperformed any other asset class.
Well, the next one's house and land data that we're going to say here, and it is interesting looking at an area like Melbourne when you're comparing the house and land long-term compounding growth rates versus the established, it's 4x. So just to give everyone what that is in actual terms, house and land for Melbourne, 1.6% average long-term compounding growth rate, Perth 5.4%, and Brisbane 12.9%. So just repeating the established figures I said there, established Brisbane was 14.3 versus 12.9, so not too far off actually in a growing market. Perth is a massive difference, so 12% for established versus 5.4% for house and land. And Melbourne, like I said, they're well underperformed house and land versus established, 1.5% house and land versus 7%. Any big surprises there?
No, so again, going back to my first point, both Perth and Brisbane showed that the upside of established house was significantly larger. Less so in Brisbane, which I can talk to that in a moment, but you look at Perth and Melbourne as the two examples there. You're talking 4x difference between your compounding growth by buying established houses instead of house and land packages in Perth. And you look at your downside in a tough market like Melbourne, again, you're talking almost 4x in terms of your difference between long-term compounding growth rate. And with those house and land packages, if that long-term compounding growth rate in Melbourne's circa 1% over the last, say, 6 years, inflation's been running at 3%. So you're losing money. You're going backwards in those house and land packages. So it sort of highlights that during the good times, you don't make as much money in house and land packages as you do to most other asset classes. But in the bad times, you're well behind the eight ball. So it just doesn't sit well as an asset in anyone's portfolio based on these numbers.
I think that's a key stat that you just mentioned there, or key point of difference is look at that inflation data, because if it is below 3%, you're in negative territory each year.
Yeah, well, you're better off putting your money in the bank, right? And getting interest off that to at least hedge against inflation. And there is risk with property because when you've got money allocated to a house and land package, what also is not factored in is the fact you bought land and you didn't have a rental income for 2 years while there was construction. If you're building through COVID, it was likely 3 years. So you're paying debt on that land. So there's another opportunity cost of $80,000 of serviceability that you weren't receiving in income. So if you net out all your costs, you're going to be well behind in that scenario.
Let's talk through apartments, which, as we mentioned earlier in the episode, this is high-rise, generally off the plan, newer stock with an abundance of supply. Apartments in Melbourne, no surprise, a lot of negative media over the last 10 years. Negative 1.3% long-term compounded growth rate. Perth, 5.7%. There isn't a lot of this stock in Perth comparing to something like Melbourne, probably why it's done better than what Melbourne has from a long-term compounded growth rate. And Brisbane at 9.7%. Any shocks with that one?
Probably Brisbane. You see apartments move at that velocity, 9.3% over 5 to 7 year periods, massive. But understand that in Brisbane, they oversupplied the market in 2015 to about 17. Then they undersupplied the market significantly in the lead up to COVID. So a lot of these figures are around that COVID period until now. There has been a huge uptake in that. And apartments encapsulates everything, right, that is medium and high density. So all these $3, $5, $10 million coastal apartments get included in that, and they've been breaking records in Brisbane and Gold Coast, and we've sort of spoken about our concerns around that. So that was a surprising figure. Probably wasn't as surprising looking at Melbourne performing in the negatives, and that's if you look at negative 2% over a 5-year period compounding, that's a hedge against inflation. You're significantly behind, and that sets people back decades. So That's the cost of investing in an asset that lacks scarcity, and that's what apartments are. They're very easy to manipulate because you're building them in the hundreds, unlike, we talk about units or houses. There's much lower density, therefore harder to replicate. So, but in good times, you'll see apartments do well. Brisbane showed that. Perth showed 5.5% over the last 7 years. You're going to be happy with that. So apartments, what that tells me that during really strong markets, apartments can actually do okay. So people say out there and say you can't make money in apartments. Well, that's not correct. If you time the market to absolute perfection, you can. And there's been examples where in a rising market, you put down a deposit where you don't have to settle in 2 years. You can make 30, 40% by the time it settles, and you can on-sell it. A lot of that was happening in Queensland. But it shows, again, your downside risk is what I talk about a lot. If you don't time the market, you could cost yourself hundreds of thousands of dollars, and also, more importantly, the opportunity cost of not being in better assets during that period. So, again, similar to house and land packages, there is, when you look at the proportion of upside versus the downside risk, it's certainly, you could argue there's a case there for a rising market, lifts all ships. There's an argument to suggest that apartments can work in that environment, but it's not worth the downside risk if the market's flatline or decline, like we've seen in Melbourne.
Well, you say there is some positives come out there in markets where you do time it, but actually when we look at units, boutique units that we were mentioning earlier, something that's usually 15 or less, no bigger than sort of 3 stories, those figures are probably where we've seen the most aggressive growth. So if you're looking at units for Melbourne, 2%, so under what they saw in established houses. But actually when you're looking at Perth and Brisbane, Perth 23.3% growth and Brisbane 15.3% growth. So actually in those markets, looking at Perth and Brisbane, units have outperformed houses in the last 7 years.
Yeah, and more recently in the last 5 years, the figures will be much higher than that. And this is what we talk about. And everyone's like, well, hang on a minute, what are units, what are apartments? We've said they're very different asset types, but these units are typically in smaller complexes, often have parking, often no more than 2 or 3 levels, so you're still getting an element of land, and that's why I think they perform so well, because they're more affordable, but you're still buying a portion of the land where you can't really achieve that outcome with apartments. So yes, it's highlighted there that certainly over the last 5 years, and more recently over the last 3 years, units in Australia, in the markets like Perth, Adelaide and Brisbane, have outperformed established houses.
Let's break down specific cities now and start with Melbourne. I want to start with the weaker performer assets first and then work our way to what's been the better performing from a long-term compounding growth rate and just get your commentary there. So from a house and land package, as we've said from the start with the data, the weakest performer in Melbourne. We looked at a couple of examples in Tarnee and Melton for in terms of growth, both in negative growth. The other is off-the-plan apartments or apartments. There's a lot of examples here, actually. So we have 3 in Docklands, all different, bought and sold, all sold within the last 6 months, but all bought at different times. All those assets had a loss. Some significant, started anywhere from $13,000 loss up to $125,000 loss. I think that's been one of the biggest ones that's got a lot of attention in Australia is those Docklands apartments and the value that it has decreased on those. Any thoughts on I guess those 2 particular areas we've been looking at?
Yeah, they're very common areas where people have lost money. And the reason, to sum that up, they both lack scarcity. If you look at Melton and Tarnee, there's an abundance of land around them where they buy a house and land package today, and then in 12 months' time there's a new estate, it's got newer property and more desirable than where they currently are, and that's why the asset itself depreciates and you're just hoping land value increases. The off-the-plan apartments, to say blanket rule that you can't make money off the plan is incorrect. You can, and those particular examples are areas where they're oversaturated with similar stock. There is no scarcity or very limited scarcity, and there's nothing unique about that. But if you see some of those very boutique apartments in, say, the areas of Brighton or St Kilda, where there might be 10 or 12 and they've got ocean views, there's a lot of scarcity. They're very hard to replicate. They've had a very different outcome in terms of their performance over the last 5 to 7 years than those Docklands apartments. So they are highlighted examples where they have really underperformed. But in doing my research, it was very difficult to find a house and land package area that had seen any level of positive growth in Victoria over the last 5 years. Very difficult to find.
Do you see that trend continuing as well? So we've mentioned the figures at the start, and we'll delve a little bit further into them in Brisbane and Perth, where they've been on a cycle, and although they have been one of the weaker performers, they've still had some growth. Do you see an area like Melbourne, which is coming out of it, the bottom of its cycle, and going through a bit of a growth period in some areas? We've said a lot on the podcast, it is patchy. Do you see some of those areas starting to have some growth, or obviously anyone who's been bought in the last 5-6 years is going to still be in negative equity? But if you were to get into the market, is there opportunity now, or is there still an abundance of stock available?
As you've seen with the data that we've just gone through, Reece, a rising tide will lift all ships. So both Brisbane and Perth for house and land packages and apartments saw quite a positive outcome. So a really strong market will lift all ships, but it's all about your opportunity cost. Do I go and buy something in a good market that gives me 5% uplift per year, compounding growth, or something that gives me 15 or 22% upside, and then during a down period, that same asset that's got me 5% upside in a rising market gives me 1 to 2% upside in a down period, or sometimes it goes backwards, negative, declining price growth in a downside? Or do I want my opportunity cost, where I put my money and the debt that I get to carry me forward, into assets where I still get upside in a stagnant market or a market in decline? And there's examples where that can be up to sort of 5%, but I get disproportionate amount of upside when the market kicks. And we're talking 20, 25 examples of almost 30% growth in some asset types during periods of time. And that's where I personally want to invest, where I limit my downside risk. And we can see, and we're seeing at the moment, not all assets are immune to all markets under all circumstances, but you can limit your downside and maximise your upside. And I think Melbourne highlights that extremely well with those examples. Yeah,
and you mentioned this when you were kind of wrapping up from an apartments perspective, but looking at going onto the stronger performers in Melbourne, the units, established units or boutique units, you're looking at areas like South Yarra, St Kilda, Elwood. All those assets had some growth, some ranging from 15,000 depending on when they were purchased, all the way up to 205,000 of profit, which is a tell story when you're looking at an area that, as a macro level, has been in decline. There has been some green shoots over the last 5-7 years.
But it's characteristics of what a unit is in the suburbs that they were built, right? So if you look at these units, they are in blue chip locations because they're older suburbs. So South Yarra, St Kilda, Elwood in Victoria are very old suburbs. And when they started to build lower and medium density units, they were mostly in the 60s and 70s when these suburbs were up and coming. Compare that to apartments. Apartments typically now only get built in CBD locations where it lacks scarcity, or the house and land are in newly developed areas. So there isn't a surprise when you look at where units are typically built and when you're buying those units, because they're underpinned by very established locations that are landlocked and the fundamentals are quite strong.
Awesome. And then just the final one for Melbourne is established houses and even townhouses to that certain extent. A lot of the areas you looked at here, Pascoe Vale, Kew, we're looking at Williamstown, Sunshine. You even added a couple in there in Geelong, North Geelong, and Bell Park, yep. Bell Park, Geelong. All these assets, from a price growth, minimal at 30K all the way up to $500,000 in terms of growth. Once again, sort of paints the picture. The micro data can tell a different story to what the macro data is saying over that period, and it's all about location and asset type is going to get you the best growth.
Yeah, it's same time period, same asset type. One performed over that period, and you made $30,000 between buying and selling, and one you bought and sold and made $500,000. Same overarching state economic conditions. So it is asset selection on a micro level that highlights that exact point.
Moving on to Perth and Brisbane, we'll combine that as a whole, as they're not running simultaneously, but similar cycles. Looking at the house and land, both for Brisbane and Perth were underwhelming compared to the other results the other asset types had. Looking at some of the examples you've got here, where you're seeing growth anywhere between 145,000 and 250,000 growth between the Brisbane house and land and the Perth house and land. It looks like a lot of the entry cost is below that 600 or 650. Do you think that's a big driver for why these house and land package areas did well, was the price point?
Yeah, so why I think you've seen house and land work in the most recent cycle for Brisbane and Perth because of the replacement cost. A lot of these examples were potentially bought and built before COVID. So when you look at a house and land package, typically you're buying land, you build a house, the house depreciates and the land goes up in value. What has been unique over the last 5 years, which I don't believe will be unique for the next 5 to 7 years, is that anyone that's sort of built before 2022, prices to build that house have gone up in some cases 50%. And that's massive, right? So instead of building a house for 400,000 Reece, that same house now costs 600 grand. So there's been an artificial uplift in the house and land package space because the land's probably gone up as well, definitely, but certainly not at the same rate as building costs in those areas. So if you bought a block for 300, I built a house for 400,000, that's now worth, collectively 700. But what's happened is the replacement cost to build that same house has gone up to 600. So now it's artificially lifted the house prices. So I think that's why we've seen house and land perform better in certainly Brisbane and Perth, and why we've seen it better net outcome over the last 7 years in comparison if you track it back for the last 20 or 30. And I think if we forecast out over the next 5 to 7 years, we will see that compounding growth figure come back to likely probably well below 3%.
Looking at units across both Perth and Brisbane, we spoke about it earlier in the show, that's where the biggest growth has been across both those capital cities and as a whole in Australia, for that matter, from a capital city perspective. Some of the growth is, astonishing on some of these examples that you've had, all the way up to nearly 600K profit. The interesting thing is the price point as well. So I don't know if that's got anything to do with affordability or even just replacement costs like you were mentioning there. These Brisbane examples you've got here, the purchase price was in the threes, sold for high eights as well. So you can clearly see, big uplift there, but obviously from an affordability play. Some of the Perth ones probably later on in the cycle as well at, in the mid fives and selling for 900. So is that what's driving a lot of that unit stock as well, the affordability play and also the replacement value?
Exactly. And so it's not immune like the house and land package space, where houses, from 2020 to 2024 went on an extreme run. We didn't see the same level of growth come into the unit space until about 2023, but they have led the charge from 2023 through to 2026. And it is, you're looking at some units when they were buying in Brisbane, when we're looking at those Brisbane units for 350 and in Perth for 400, the replacement cost on those units to build them was 700, 750, and they've gone well above their replacement cost, trading now at sort of 850, which is highlights that point. When you look at that Melbourne example, we're now buying those units for 450, and the replacement cost is 700, 750. So let's talk about replacement cost is if you just believe in the fundamentals of mean reversion, that assets will get back to their replacement cost. But that has been a key driver, and the affordability. Obviously, we've had a government that's thrown in first home buyer grants that stimulated that sort of sub $1 million price point, which highlights those assets under that price point. So you could argue that some of that is somewhat artificial because the government stimulated that point of the market quite aggressively late last year.
Let's summarise the episode. So Melbourne asset selection has been critical. Established homes and units have actually largely outperformed the market, while house and land packages and off the plan have underperformed. Brisbane, strong growth across the board. Almost every asset class has had...
Doesn't matter what you've purchased in Brisbane, you've made money.
You've made money, but clearly units and established houses have been leading the way. Perth was the standout market with impressive growth across the board, particularly in the established stock, not as well on the house and land as say Brisbane has, but overall, from a growth perspective, the standout performer.
Yeah, like across the board, and I think it highlights that. And we're very anti-apartments and very anti-house and land packages. Don't get me wrong. In a hot market, like I said, a tide will lift all ships. A rising tide will lift all ships. They do grow, and that's the example. They have gone up in value. When you look at the opportunity cost and your money tied up in assets, hands down, houses and units, boutique units, win hands down, and there's no denying that. So I think that's important when you're assessing your situation to understand your downside risk, but also maximise your upside when the time's good and the markets are moving.
You've been listening to the Follio Property Podcast.